want to welcome you this afternoon. We really apologize for delay. A lot of people kept on calling that they are stuck in this load section down here, and that's why we gave a few minutes so that at least we could have people who were very keen to be with us to have reached. And I've seen the last team that had called walk in, so allow us then to start releasing the results for the third quarter of the year 2014. Looking at the macroeconomic environment in the region, we're seeing very significant changes happening. The first one is that we have been underestimating maybe the contribution of the informal sector, and that is the only thing that I can explain a 25% rebasing of a GDP of a nation. And that realization, to a great extent, will also explain why the results of equity are what they are. It's because we see the economy maybe has been growing faster than has been captured. The revision of last year's growth rate from 4.7 to 5.7% is very telling, given the size of our economy relative to the other economies in the region. Its keen eye have, of course, seen the pressure that the Kenya shilling is under, the exchange rate changing from 87 to 89 over the last 3 months. And there's speculation what will happen. But our perception is that the lifting of the advisories by Germany, US, and the UK may help the tourism industry to revive. And since that was the biggest cause of that strain, we may see maybe that pressure easing. We are optimistic that the global tea prices will peak. This year's tea total sales or exports were at almost 50% of previous year's value. And again, given that tea is the largest foreign exchange earner, we believe that is the two factors that have caused that pressure. But we are seeing an increase in diaspora remittances. We are seeing an increase in the flow of investments, and we are seeing increased activity in the Nairobi Stock Exchange, and that we believe will ease that pressure, and we anticipate maybe fairer and significant stability. When we look at other factors in the economy that might be driving, we see the persistent pursuit of the regional integration. When there is a problem, those who are willing moves to a club of the coalition of the willing. That tells a lot about the political will, about integration. And for us as a bank that is operating within the East African region, we are seeing the benefits of integration. We are seeing the harmonization of policies and consequently the ease of doing business. We are now, for instance, being inspected by an inspection college of all the central banks put together. So the issues of explaining to one regulator what you explain to the other then doesn't align. So we are seeing significant transformation out from that. The advisories are serving two purposes, not just supporting our tourism, but helping rebrand the country. We are all aware that it appeared Kenya was feeling isolated, or there was a perception that Kenya was being isolated. And since the African-US summit that was held earlier in the year, we have seen the perception towards the country significantly change. The presence of the UN Secretary General in the country this week, accompanied by the President of the World Bank, the President of the Arab Development Bank, the African Development Bank, and the European Union team tells a lot about what the perception towards, and it will be almost a whole ecosystem. You imagine what will happen to housing, you imagine what will happen to the retail sector, and to a great extent, employment and even flows of foreign currency, because they are paid in foreign currency and spent in our restaurants in local currency. So again, we are seeing those are drivers to the environment. And of course, in the banking industry, we are seeing significant enhancement in credit information sharing and enhanced innovation, particularly in the mobile space and the payment space, together with the agency. And that's what we are seeing is opportunities to deepen financial inclusion. The tools that are relevant, are necessary, are now in place. And that gives the banking industry an enormous opportunity to grow on the back of those who have previously been excluded. But we can't really talk about what is happening in the region without talking about the massive investment that we are seeing in infrastructure. The 10,000 kilometers roads to be done in 3 years. We all know what development of such an infrastructure will mean, particularly to opening up rural areas, reducing the cost of transport in the country, creating employment, and also supporting the ecosystem of the supporting small and medium enterprises. And that basically will be a big opportunity for the banking industry. The manner and style in which it's envisaged, where it is the banks that will lead to the contractors to be paid through annuities over 8 years by the banks, then favors banks like Equity Bank that has big balance sheet and big capital base. So we can't even wait for January, and we are talking already to the 47 contractors who have been shortlisted. So we are seeing the banking industry availed an opportunity that will support it for rapid growth. But the big opportunity comes with the bigger infrastructure projects. The standard gauge high-speed railway line commences construction on 7th of November. And you could imagine the subcontractors who provide the materials for such infrastructure. Leave alone the steel requirements, even local ballast. You can imagine an SME contractor given 20 kilometers to put, but what it will mean to this sector. We can't wait to see the proposed Ramu Uganda crude oil pipeline to open the oil fields in Kenya, Uganda, and South Sudan. And when I visualize myself construction of such a pipeline at the same time with a standard gauge railway line, I see this country going through what Europe and America went through when their railways were being constructed. And for the banking industry, that really positions as significantly. The Port of Mombasa are now the second container terminal is nearing completion. Just a year after Berth 19, again shows the efficiency of the bottleneck that we have had with our port. Will make this region very attractive, particular, and reduce the cost. And hopefully Ramu will take off in a bigger way. But when you look at the integration of the East African community, what it is producing is closer reduction of differences in microeconomic indicators. Whether you look at GDP, current account to GDP, whether you look at exchange rate, whether you look at private sector credit growth, whether you look at GDP growth, we are seeing the gaps narrowing. And that is what I was saying, the integration in one way or another is narrowing down the indicators, suggesting almost a uniform block of an economy. So to a great extent, we are seeing this region emerging to a consolidated market. It's a single market to a great extent, and that will make easy trading, because if the exchange rates are, have the same stability, if the inflation rates are almost across the same rates within the region, then we see the trade prospects improve significantly. And that is also true when you look at almost the interest rates that are being offered in treasury bills, whether it is in Uganda, whether it is in Kenya or in Tanzania. So you can, the range exists because the economies are at different levels of reforms. The economies are at different levels of development, and consequently the structures are different, and different drivers are being applied by the treasury margins. But the margins or the gaps are narrowing, and that to us is very, very attractive. And of course, when you look, for instance, inflation, the trends are almost going to the same direction, and that is very, very exciting for the financial sector, where all the, so that is the environment that we are operating in, an environment that seems to suggest that we haven't seen the better side of our times. The better times are ahead. We are coming from challenging macroeconomic environment to more stable, more promising, and most likely more rewarding economic environment, easy to operate, lower cost of operation, and significant growth within the environment. Let's go to Equity Bank and see how Equity Bank has positioned itself. Equity Bank, over the last 5 years, have been positioning itself for this envisaged macroeconomic environment. And the first thing we did was to try and make ourselves a financial sector house, such that we are providing all the financial services. We knew we had a huge customer base. By the end of this year, we'll have surpassed 10 million customers. And we realized we could cross-sell beyond a loan and a savings account and a current account. We are now cross-selling to them insurance, so we have insurance products and bank assurance. We are cross-selling them brokerage services, custodial services, advisory services, investment opportunities, as well as increasing the range of our banking services. We are now looking at the customer base and segmenting it so that we can have laser-sharp focus on the needs of each segment. We're trying now to study our customers' consumption journeys or lifestyle, each of them, and asking, as they move, what is it we can do? Can we accompany them on their journeys of livelihood? And lastly, we have seen that we need to have a more agile, more cost-effective infrastructure. And while in the past we have relied on delivery channels, alternative delivery channels like ATMs, we have relied substantially on brick and mortar in terms of branches. We see the future will converge financial services to a great extent on electronic delivery channels. And our choice and our prediction is that the mobile channel will be the channel to beat. It's the most effective, the most agile, the most convenient to operate, and from the bank's perspective, the least cost channel, because you don't own the phone, so you don't finance the phone, you don't service the phone, you don't operate the phone, neither do you depreciate the phone. So all those costs that are associated with the fixed cost infrastructure will all turn variable cost to a great extent. And it's for that reason we have acquired the MVNO capability and FinServe, and that is the infrastructure we think will road the bank that we are building on. And if we can reflect a little bit how this group of bundled financial services has evolved, we can see an evolution from business model perspective to legal structures, technology based, and now we are seeing more of a future where we leverage on technology, we converge financial services along the channels, we'll have seamless integration of channels, we'll be able to do segmentation better, and we'll scale the brand and its royalty through royalty, huge royalty program. So we are seeing the bank is no longer intermediation. We're slowly moving from intermediation. Intermediation is the core business, but we are asking ourselves, how innovative, how creative can we be allowed the core of financial services? And we see ourselves providing a host of financial products, but at the same time, also offering a host of value addition products from the ecosystem that our customers need. We think we'll be a provider of lifestyle into the future. We'll be a processor of everything a customer would do in their life. So that is the bank that we are envisaging, and that is the bank that we are building slowly, and we would like you to evolve with us. We would like to walk this journey of evolution, because the more you understand this journey of evolution, the more exciting it is for us. It's very inspiring when you start seeing we are redefining what banking is. But looking back, this bank has been an award-winning award. There are many awards we can talk about, but there are 3 or 4 awards that make us very, very proud. And the first one is being named the best bank in East Africa this year. We are a regional bank operating in East Africa, and to be branded the best bank in East Africa is very, very fulfilling. To be branded the bank with the lowest charges in East Africa, again, you're not just the best bank, but you're also the most affordable bank, the bank with the lowest charges. Again, it shows that the growth that we are experiencing, rapid growth, is because we have been able to price financial services in a way that in the minds and the eyes of our consumers, we are being seen to be fair, just, and maybe also affordable. But it's the transparency in pricing, the award of transparency in pricing, again, a confirmation about what our values are all about. Professionalism and integrity is a word that we hold very dear. That, yeah, when you look deep, these are not just a word, but our pricing model and the way we communicate our charges it's very, very transparent. And all put together, we have emerged the top banking brand in Kenya. So again, so that consistency confirms the narrative. So it means whichever direction you look at it, whether it's brand, whether it's transparency, whether it's pricing, whether it's offering, whether it's popular, the bank seems to be a leader in every aspect. And when you look at, because narratives are good, but sometimes you need to throw a dipstick and see what do the numbers say. And when you look at the global credit rating of the bank and see it enjoying a AA rating long-term and an A1 plus short-term, then you say, yes, beneath these awards is a very solid bank in terms of all financial aspects. And with a stable outlook, again, you're very confident that risks are properly managed. But it is when we are ranked globally, it's good to be the best bank in Kenya. It's even better to be the best bank in East Africa, the best bank in Africa in 2 respects, return on asset, return on equity. But it's very good to be ranked among the top 1,000 banks in the world and then emerge as number 4 best bank in the world in efficiency, number 8 in terms of capital deployment efficiency, and in terms of soundness, 112 best bank in the world. So then you say you're offering your customer everything good that they will require. It's really nothing really that really needs. It's a very balanced model that speaks to what is important, what is critical in banking. But that has been rewarded very well. When we look at our market share and market leadership, we see we are leader in almost every respect. We are leader in terms of proportion or market share in terms of profitability, enjoying nearly 15% of all the profits of the banking industry. Is something that is rewarding to the stakeholders in the bank. It not only rewards the investors, but gives us confidence as management that we can scale this bank, and this bank is sustainable. And particularly when you achieve 15% of the market share in profitability, when you are the lowest priced bank, then it shows the efficiency in the bank. And it confirms our model where we focus on volume, high volumes, low margins. And that again explains the possibility of the bank continuing to grow. But it's also significant that we are the biggest bank in the region in terms of market capitalization, at least 25 billion shillings bigger than any other bank in the Nairobi Stock Exchange. So this market share, again, is not just profitability, whether you go to deposits, whether you go to loans, whether you go to assets, we are a leader in every respect. But we are a leader in market share in number of customers. We hold nearly 50% of all bank accounts in the country, again, reinstating the confidence the public have in the bank. Sometimes we talk of numbers as numbers occur in abstract. I want to pay tribute to the leadership team that has delivered on these numbers. Numbers don't just come, they are delivered. And this team, an organization can never be better than its management team or its leadership. All those beautiful things I was saying about equity reflect this leadership team. And as you can see, the diversity of this team, both from nationality, to gender, to skills, to competencies, to experience, that is why equity performs the way it is. That is the executive global team. It's supported by a very strong management team that then do the day-to-day management of the, again, a very diverse management team, a much younger management team. And that is what excites us about equity. Equity is about 4 generations. I think we are now creating the 5th generation, all split by nearly 10 years of age. And so you could almost see 5 generations or 5 successions all coming in place. And that management is not just restricted in Kenya. When you look at the region, again, formidable management teams come in, whether it's in the professional and technical aspects like investment bank, we're attracting the best that this region has ever produced. And we are really glad that equity is really the employer of choice when it comes to young professionals. We're really proud that we can nurture. But we are successful because we are supported by a very powerful technical team, a very global technical team. And the ability of equity to attract. You can really be good in managing and providing leadership. But if the platforms, the technical platforms on which you operate are not solid, then you have challenges. The ability of equity to put together this technical team to support a leadership and management team and our staff in doing what needs to be done is what equity over the last 5 years have said banking is good and we can grow intermediation. We can grow loans and we can grow deposits, and that is what traditional banking is all about. But we initiated a couple of strategic initiatives. Initially, they were informed by the structure of our customer base. We looked from micro enterprises, we looked at SME and corporates from the business side. And we, on the retail, we looked at the consumer, to a great extent, agriculture. As we developed our customer base, we have seen there has been a lot of transition and a lot of graduation. From the SMEs, we now have large and medium enterprises. And from the consumer and individual customers, we have high net worth and affluent individuals. And this, together with a mass retail customer base and a very significant SME base of about 400,000 enterprises, and then a little bubbling micro enterprises, and a significant portion of newly included banking, we see ourselves fulfilling our ambition of being an inclusive bank. But inclusive bank requires a different model. It requires perfect segmentation to reflect the needs of the customer. And that is what has caused us to really drive specific initiatives so as to address the specific needs of each segment. So the segments that we have really been focusing on is SME. And SME, within a very short period, has now grown to contribute to 46% of our loan book. Merchant business and payment processing is something we were not doing 4 years ago. It's now the fastest growing segment, growing at 65%, and bringing all the merchant ecosystem to bank with the bank. They don't want to be paid over their money. They want the money to be retained into the bank because it's more efficient and more effective. We've seen the need to segment and meet each segment with the appropriate delivery channel. And particularly for the mass market on the bottom of the pyramid, we have seen agency is very, very powerful. We have seen mobile banking very powerful to this consumer segment, and particularly to the youthful segment. And all this is now being free. And we have seen the number of agents, for instance, growing by 73% year on year. The diaspora has become a significant driver of the Kenyan economy. Foreign direct investments to the country, as a total of funds have been overtaken by diaspora remittances, and today, Equity is controlling 17% of all diaspora remittances to the country. And we are seeing the need to offer different products and to provide a regional platform of financial service provision. And we have seen significant growth in the range of products we are offering, while we consistently build on the platform that support all these services together, such that we have a single database for the product. So the investment we made in the past on our IT platform continues to provide huge. And of course, when you become a market leader, then your biggest challenge is to build a brand that continues to be respected. It's, again, very humbling for us to be a market leader in almost every respect, but at the same time enjoy an iconic economic and social brand with very significant social impact in the society that we are living in. And again, that is something that we are very proud. So we'll look at this initiative one after the other and see what we can see. As we said, agents have now reached almost 16,000. We are seeing agents is a channel accelerating financial inclusion. We are seeing agents reducing our cost of delivery because it's a variable cost channel. And we are seeing that while originally we targeted agents to do cash deposits and cash withdrawals, we've realized now we have developed them to be able to do account opening, origination. They are doing balance and query, and we are exploring the potential of using them to do insurance sales. We are pilot testing that with 300 agents. Air tickets for Kenya Airways, we are just integrating the system, originating loans, and more importantly, provide telecom agency services for Equitel. All the 15 agents are also becoming the agents of FinServ. So again, we are seeing the agent model that we developed will be a very attractive model that will make our offering very, very rewarding, and the partnership then would grow. So if you look at the amount of money going through the agents, it's very, very significant. Agents are doing more transactions than branches and ATMs combined now. And I just want to remind you, agents started just 3 years ago, when branches have been there for 30 years. ATMs have been there for 10 years. But combined, now they are doing less number of, as we can see in the numbers being reflected there. But it's the volume of turnover of deposits. But if you look at the deposits and withdrawals, let's look at the quarter ending 30th September 2014. The amount deposited through agents was 45 billion shillings, but only 18 billion shillings in withdrawals. And that is what we are saying, it's really mopping the money that was previously under the mat. And you can see it's the same, the second quarter, 45 billion in deposits, only 17 billion in withdrawals, and on, and we can see deposits are growing faster than. If you look at the mobile option that we are really promoting, we can see the uptake of the mobile infrastructure, the mobile channel, growing at the compounded growth rate of 35% annually. And the devices continue to increase, and the ability particularly to use tap and go because of near field capability, and particularly embedded on a SIM phone that is likely to happen to the bank. Why? Because it provides for the first time globally a convergence of telecom and banking, and in a secure manner. So we are seeing the mobile devices that could be put on or connected to financial services. The ability to use the phone now makes it possible for us to visualize that in not too far distant future, things like Facebook, things like Twitter will be part of our delivery channels. And you'll be operating your bank from your Facebook account. And those are the things that we are now, but you can't do that unless the channels are secure. And that explains why it was absolutely necessary for us to get an MVNO where we could get the secure element and ensure all information and data going through the channel is encrypted, such that even if you hack and intercept, you can't be able to use or misuse the information. The ability to get, again, the SDK capability and to load software on the SIM card has the capability of converting all feature phones into to have the capabilities of smartphones. And again, you could imagine the ease at which then transactions can be processed. But it's the cost aspect, both to the customer and to the bank, that has significant benefits being delivered to all stakeholders. The status on this, because people keep on asking, is that Equity has rolled out Equitel in a soft manner. The reason why we have not launched Equitel is because the uptake is too heavy. Every day, like yesterday, we gave out 6,700 SIMs. So if we launched, we are not sure we could be able to cope with the numbers, since we can only issue these SIMs in the banking hall. So we don't want to destroy the banking capability because of issuing SIMs. So we want initially to deal with those who are very passionate and enthusiastic before we start. So we are dealing with customers, and so far, in the last 10 days or so, we have issued over 200 SIM cards, and we are seeing the number of calls going through those are very significant. And the revenue streams we are seeing something that will be interesting, and we'll be sharing these as we go on. The second thing we wanted to clarify is that we were given unconditional licenses by CAK and the Central Bank of Kenya. There is a perception in the market that it's for 1 year. There is no restriction, there is no qualification on the licenses we were given. It is CAK that said it will continue to monitor for the next 1 year, but nothing to do with us. It's what they said they would do, but our license was unconditional. There is also a perception in the market that Parliament stopped CAK. CAK has confirmed to us Parliament has never written to them on that kind of perspective. So all these, there is something that needs to be collected. So Parliament just made an inquiry. They wanted to understand what was being debated in public. So essentially, we would like to less, particularly for the analysts. So we wanted to speak to the analysts directly and say there are no challenges that are being perceived at 1 year. Parliament is doing its role of really making an inquiry and seeking information. And lastly, Parliament, even if it got information, it could only make a recommendation, because we are all aware Central Bank and CAK are independent regulatory bodies that are independent of oversight by any other party. And the other misconception that is in the market is that Equity is riding on all networks. That the fact that we issue SIM cards, it's not true. We are only using Airtel network. So what it means is whoever customer we give the thin SIM will have 2 SIM cards in the same phone, one answering to the existing telecom provider, and ours, the thin SIM, responding through the Airtel network. So there is not connectivity between the 2 networks. So all these issues we have been hearing of, oh, it's not true, because they respond to the signals from the same network. And the essence of the thin SIM is to save 27 million Kenyans who have a single SIM phone the cost of buying a second phone. And if you take an average of 4,000 shillings per feature phones, we are talking of saving the country approximately 104 billion shillings. It's optimization of the resources the Kenyan people have and the country. It's sweating your phone much more and service. That's all that the thin SIM is all about. Let's go to SMEs. And SMEs is where we have seen, and we're very excited, because the wealth of a nation is created by enterprises. Seeing Equity now combine large enterprises at nearly 20% and 46%, it means 65% of all our lending is going to productive sectors of the economy. It's helping and empowering our customers to create wealth. It is no longer consumption. And we are very excited that consumption has moved from 38% to 24%. We're saying we are building a better nation. We are helping our customers to build wealth. We are helping Africa to create its own wealth and to fight poverty. And more importantly, it is enterprises that generate opportunities for employment. And equity in significantly is now contributing to the transformation of this economy. And we've built enormous capability on SMEs because we believe by putting our SME clients on the supply chains and value chains of the international companies operating in Kenya, whether it's Taro, whether it's IBM, whether it's the railway line construction companies, will transfer a lot of skills and competencies to our people. So the focus will continue and we'll see more and more growth in that sector. We'll also see significant growth. As we said, we are now holding 17% of all the remittances, and we can see the incomes starting to grow. We can see between 2013 and 2014, the growth in terms of commission is not commensurate with the growth in market share. It's simply because we have reduced the cost of remittances significantly. We are now offering direct remittances, for instance, through Equity Direct from the US and from Europe at a rate of only 1%, down from 13%. So essentially, what we will see is significant volume. But it's the ability to harness the ecosystem of merchants that is a little bit more exciting. We now have all the tools that are available in terms of global payments that we have availed to all the merchants in Kenya. One POS is able to host all the payment channels that there are in the world. When you have an equity POS, there is no card that can't run on them. There is no card of any bank that is connected to any of these channels that would. And as we saw earlier on, we, as a result, can see the enormous growth rate in terms of transaction counts and revenue the bank is enjoying. And we are glad that we focused on this initiative because this will be a sector that will grow significantly as we become cash writers and economy. As we move away from cash to plastic money, to electronic money, this sector will grow, and we have become the acquirer of choice of the world's top regional expansion. We have talked about regional expansion of the last, and sometimes we have felt we had not been fully understood because our 3-year-old subsidiary in Tanzania, Rwanda, 5 years in South Sudan, and 6 have been compared with subsidiaries of our competitors who have been in these markets for 15 years. But I'm happy to say we have stopped crawling. As you can see, we are running. Year to date, profitability has grown by 137%, loan book by 35%, assets by 52%, and we can expect going forward the subsidiaries will start making very significant contribution because they can sustain this growth rate for the next 10 years. If I remind you, equity sustained 100% growth rate for a period of 12 years. So when you are small, they are small. These markets are not as competitive. These markets are not as banked as Kenya. These subsidiaries will significantly contribute to the profitability of the bank going forward. Because these subsidiaries has become profitable, we have now focused on non-bank subsidiaries, and next year this time, we'll see how much custodial will contribute, we'll see how much brokerage will contribute, the investment bank, the equity consulting group, more significantly, Equitel and the FinServ brand. Again, those are now the new kids on the block. As we have said, the subsidiaries now don't require the attention we are giving them, so we have picked another 5. And the reason why we have picked these, instead of going out to pick another 5 countries, is because these ones is all about cross-selling. We are cross-selling to a database of 10 million customers. All these figures are good, but what makes us very proud in Equity is what this Brad has been able to do on the social side. And when we look at the pillars that we are focused on, scholarships, things like the Wings to Fly, leadership development, resorting to 200 scholars being sent to universities abroad to acquire the best education in the world, we think Equity is not about making money. Equity is about changing society. Equity is about transforming and making society better. And this becomes even more clearer when you look at the impact that we have made on this. We are seeing, like the youth empowerment fund that we give loans to youth, 12 billion shillings have been released to youth so far. We're seeing 27 billion shillings released to women under Fanikisha. We are seeing 1.2 million women and youth trained on financial literacy. We're seeing 460,000 peasant farmers converted into agribusinesses, and we are seeing 10,000 kids on full scholarship studying in our secondary schools, principally the national schools. And we are seeing 200 scholars out of the country on full scholarships so that they can have global networks, and 2,000 scholars in our public universities. That is what excites us, all of us. That is what makes us happy. That is the impact of Equity beyond financial impact. But financial impact is also important for sustainability. So let's look at the figures now. And looking at the figures, the best figure to look at is the growth in number of believers, what we normally call members. And we're very optimistic that before the end of the year, we'll clock 10 million members. And it's that database that then allows us to operate a high volume, low margin model that provides stable funding and short-term loans that are customized, and also makes our delivery channel strategy viable. Without huge numbers, you can't have the delivery channel strategy that we have being viable. This customer base has provided us with 339 billion shillings. So when you look at the funding aspect of that customer base, and you look at the growth rate sustained from 2009 at a compounded growth rate of 29%, that gives us confidence. It is the distribution of that funding that makes this bank what it is. 51% of 339 billion shillings in deposits is in savings, and 36% is in current accounts and wholesale deposits that you may not count on stability. They only constitute 13%. And so again, that is how, and it's the stability. If you look between 2014 and 2015, the ratios and proportionalities have been maintained to a great extent. Deposits control 71%, actually 72 at both years. And when you look at borrowed funds, that has increased a little bit from 25 to 34%. And shareholders' funds have remained again proportionate during the 2 years. A growth in balance sheet at 27%, yet the second biggest banking balance sheet in East and Central Africa. When you compare that with the average growth rate of 13% of the banking industry, it tells you how fast equity is growing, and that is why the market share continues to increase. How has that funding been applied? That funding has been applied to support our customers by building an asset that is loan biased. So we see loans taking 60, previously, the previous year, 59%, but that increased to 61%. And then we see government securities to provide the liquidity buffer that is required, and then cash and cash equivalent to provide the working capital. That's simple, no frills, sticking to the core. Loans, treasury bills, and cash. That's the model that we have operated. A very liquid balance sheet, again, underpinning the stability. And again, when you allocate, large enterprises are growing faster. What it means is that our SMEs, as they get bigger and bigger contracts, they are graduating to large enterprises, but also our micro businesses and our consumers are graduating to small and medium enterprises. And it's the quality of the loan book, the continuous improvement in the loan book. Previously, last year, this time, 5.5, and now we are down to 4.3 NPLs. Again, stability in that area as a result, reducing the cost of risk, while at the same time enhancing coverage in terms of NPL coverage. But all this is supported. It's not just by the market or by the customers, but significantly by a shareholder base that believes in the bank. And so capital is always ahead of the confidence of the shareholders has attracted support of those who fund institution in form of debt, and we are happy to say now to support our SME and large enterprises strategy, we've managed to obtain 35 billion shillings in long-term funds of between 7 and 10 years. And so we are able to structure appropriate. Those customers who are in export market, we're able to support them with dollar, euro denominated loans and at much better rates than local currency. The bank is slowly adjusting because of the growth of the SME. We are seeing non-funded income growing faster than the interest income. But again, it significantly affected the capability of the bank because we have been able to 0.6 to 27%, and we have managed to hold that growth, while the cost-income ratio has shown a slight increase simply because of the reduction, 30% reduction in interest income. That is what has played on that, and so one could say that is a blip, and it will reverse next year when the comparatives are seen. Defaulters in circles are being registered. We will now develop a disciplined loan repayment culture in the country, and everybody will benefit because the cost, as we saw last year, provisions of 2.4 billion, that was a cost that was passed on to the consumers. That has been the problem. When you have a country that experiences high defaults, then interest rates are normally high to cover that default. But we are seeing that eventually coming down. The capacity of the borrowers, again, we are seeing that being enhanced, and we are seeing the loans that are being borrowed growing in size. The bigger the loan, the lower the interest rate, if the risk is also proportionate to the size. So we are likely to see that significant. In terms of developing leadership, this bank has always developed leaderships. It is from the ranks and file of our management team that we have appointed a managing director for Tanzania. That is now an experienced managing director for 3 years. We have a managing director in South Sudan who has now experience of running a country and reporting to an independent board for the last 6 years. In Uganda, I think it's 7 years, and in Rwanda, all those are homegrown MDs. And if you look at our management team, you can see how seamless it is that by the time the approvals come, we are ready to separate the management team. That is how grounded equity is in developing layers of leaders. And that is how easy getting people from one position to the other would be. So I see no challenge. However, as I emphasized, I can see in the medium term, the group management team will be involved in managing Kenya, because Kenya continue to be nearly 90% of the value of the business. And if you look at Kenya, while the subsidiaries are growing, and we saw at 137%, Kenya growing at 30% because of its sheer size. It will continue to require the attention, because if we removed the group management team, they would be managing the others, only contribute maybe 15% of the total business. So it will be important for them to remain focused in Kenya. There's another question.
My understanding is that the establishment of the holding company is generally just cosmetic, yeah? And has no financial benefit or loss to the shareholders. I know you have, the last answer you gave, you to some extent talked about the impact of that on the operational structure of the bank. And I think for me one of the key things is with all the different subsidiaries, the likes of Equitel or FinServ and so on, could you just sort of break down how that structure would look like from an operational point of view?
I want to invite the Director of Strategy and Director of Legal Services and Company Secretary maybe to answer. What are the benefits rather than financial, and including financial benefits of creating a holding company, and what will be its relationship with the other subsidiaries, and how will the structure look like? Mary.
Thank you, Mr. Olo, for that question. I think James had touched on the structure as it will be, as it's proposed, because obviously it's subject to the shareholders' approval and also the regulator's approval. But at the end of the process, if we finish and complete, we'll have a Equity Bank, the current entity, which is called Equity Bank Equity Bank Limited, sitting at the top, being the listed company and carrying the shareholders, all the investors, and owning all the other subsidiaries. So obviously we have the new entity, which is going to be called Equity Bank Kenya. We have Equity Bank Uganda, you have Tanzania, you have FinServ, you have the investment services, and we have also the consulting group, etc., etc. They will be owned by the holding company. We are proposing to call it Equity Group Holdings Limited, obviously subject to all the approvals required. So the main role of the holding company then becomes holding those companies, and obviously just making sure that the subsidiaries are well funded, because the funding will happen at the holding company, and the funding will also be allocated from that, from the holding company. It will also be able to manage mergers and acquisitions. All the key decisions will remain at the holding company, so that the other subsidiaries remain more operational companies. If you are doing banking, focus on banking in your territory. Kenya will focus on banking in its territory. Uganda will focus on banking in its territory. If there are big acquisitions to be made or decisions to be made, of course, the holding company will have a board and will make decisions at that level. And also the group team will support all the subsidiaries just to make sure, for instance, the shared services are working and all the subsidiaries are being serviced well in a very efficient way. Procurement is happening very effectively in a cost-effective way. So that will be the role of the group management when that structure happens. So yeah, I don't quite agree that it's cosmetic, because I think you can also look at this from the point of view of an institution which also has some aspirations to grow and expand, because our vision is for Africa. So the group will focus also on looking at, are there other markets, for instance, we can tackle, or we can start thinking about. If you think about other lines of business, we have been doing insurance services, we have been doing, but as an agency. So at the group holding level, the board will decide, is it time for us to think about something, doing this business, insurance business, for instance, differently? The investment bank is already operating in Kenya, so questions will be asked as to whether are there other opportunities, for instance, in going into the region where we don't have operations so far. So that will be the role of the group. So it's more to focus on the strategic issues, and of course just making sure that in all the regions where we are currently operating, and probably any future destinations that we go to, also the business model is being followed. There's no deviation from the core, or what we believe is the core and the antecedent business. So that is how we see the role of the group really turning out after the same is established. I don't know whether it's clear.
So if I just maybe add, so if I summarize, the holding company would be where the owners, the shareholders will sit. It's where the trading of shares will be happening. Capital allocation will be happening at that level. Governance structures will most likely be happening at that level. Innovations will be happening at that level. Shared services like marketing, risk will be happening at that level. But more importantly is oversight, to be sure that the subsidiaries that are operational are operating. Budgets for all the subsidiaries will be approved at that level, so they are harmonized. Human capital will be overseen from that level, so that we could continue to attract the very best. So you attracted the group, and then you could second for specialized human skills. But the other benefits from a regulatory perspective, then you are viewed from a group perspective. Then you are supervised as a group, and all the other countries are comfortable, because it is not a bank in another country that is supervising and owning. So the issue of sovereignty doesn't even arise. At the moment, you'll find Uganda will feel the Kenyan bank is owning the Ugandan, there are those type of sentiments. But the holding company doesn't have, yes, it is domiciled in the country, but has no operations as such. It is a subsidiary that will be operating in the domiciled country. The other aspect we have seen very, very is the ability to separate the responsibilities. When you give people responsibility of overseeing other subsidiaries, doing acquisitions, doing mergers, doing startups, they tend, in one way or another, to not focus on the bread and butter, the operations, which brings in the results. So that is for that reason. But from a regulatory point of view also, the structure is very inefficient when a bank owns the other bank, in the sense, whatever they invest, like what we have invested in Tanzania, Uganda, Rwanda, South Sudan, is netted against the capital of Kenya. So you can imagine how punitive that is in meeting capital ratios. The second thing is like today, and God forbid, if South Sudan went off completely, the whole balance sheet of South Sudan would require to be written off against the P&L of Kenya. But as soon as we do the separation, Kenya will not be affected by what would ever happen to South. It is the shareholders that the group who will see. So you are ring-fencing each country and reducing cross-border risks from contaminating in-country operations. And then you can have very specialized skills. The skills of learning and operations are very different from the skills of entrepreneurship and leadership at the group level. So you could really be able to separate those two roles and become very, very effective. Hello, I hope we have responded to you.
My name is Bella from Citizen Television. I was wondering, what is the linkage between the 10 global payment companies you've partnered with and Equitel? Because in your presentation you talked about the convergence of telecom and banking globally. So is there a linkage between the 10 global companies you've partnered with and Equitel? And are we talking about once you roll it out in Kenya successfully, are we looking at other markets that you're going to roll out Equitel as well?
Thank you very much. This draws me to where the bank is going, and I can talk briefly about 3.0, Equity 3.0. Equity 3.0 visualize where what the public will be interested in is financial services. They will only be interested in financial services, not who offers them. We are seeing a future where people would like self-service platforms, so such that they get the banking services when they want them and whenever they want them. That convenience will be essential. Secondly, we are seeing that possibility being realized by virtualizing banking. We are seeing that being achieved through digitalization of everything that banks do. We are also seeing banking offering more than intermediation, taking deposits and giving loans. We are seeing banking services supporting lifestyle. And it's for that reason that we say, if banking is to support lifestyle, then it must have a delivery channel that is agile and very convenient to the user, such that they have the device always with them, so that whatever they do, they're able to complete the transaction. And that is where we saw convergence then of telecom and banking, because the telecom provides that device in form of a phone. Now, when you support lifestyle, mainly what you are talking about is paying for whatever you are doing. If you go to a salon, then you pay. If you go to buy anything in a supermarket, you pay. If you take a tax, you pay. If you go to church, you tithe. We're now talking about supporting all those activities. And in supporting that activities, it's all about payment points. And we're saying, for the phone to really be effective, to give you access to your money when you need it, to fulfill livelihood or lifestyle needs, then the phone might have the capability of payment. And for phone to have capability of payment, we are saying there is no need of reinventing what is already there. The best case we have at the moment is the issue of cards. You just have a card and you keep on swiping to pay. We're now saying, what about replacing the debit card, the ATM card, the credit card with the phone, in the sense that the SIM card becomes certified by all those global payments we talked about. And you just use near field technology and you just tap on a mobile point of sale and the transaction is completed. Such that the low transaction, the low value transactions, which may not avail the opportunity to make point of sale economical, can use their phones and you just tap and go. So that is where we are seeing convergence and payment systems and networks availing that convergence, the payment gateways, the global gateways. So such that the phone then become a payment tool anywhere in the world. When John started here, who has been our leader in this aspect, travels to the US and has to use a tube, he just takes off his phone and tap on the machine and the ticket comes out for the train. That's basically what we mean. When he goes to a shop, instead of producing a card, he produces his phone and taps on the POS and the transaction is complete. That is the convergence we are seeing. And so the payment systems were a building block to enable the phone to carry money and to process transactions, and then to do all the other banking services. We are seeing a phone being the device on which people will be applying loans. We are seeing equity in 5 years being paperless. And paperless because now, if you look, in a month's time, Kenya government issued a gazette notice legalizing digital signatures. So what it means is that you no longer need to sign on a paper. You sign on a pad, digital pen, and we no longer need archives to you file loan applications and loan approvals electronically. That is where we are going. And you can imagine how easy it will be going into the future. So the phone then becomes that device that will allow digitalization. Thank you very much. Let me, sorry.
Thank you very much. My name is Budia. When or have you started distributing the thin SIM cards? That's question number one. And if not, when can you expect to see them? Then number two, the tap and go capability. When can you expect, buy milk in my kiosk using the tap and go thing? Then number three, how many customers have you so far attracted or given the SIM cards?
Thank you, John Starry. That question is yours. When do I get the thin SIM? Two, when do I get the kiosk that is tap and go for financial services? And third, how many customers have you given the regular SIM? And what are your predictions?
I think there was a few more questions than were asked, but I'll try and answer them all. Firstly, on the thin film SIM, we had to obviously wait for the regulators. They're expensive. SIM cards, thin film SIMs are expensive, so we didn't want to bring a lot into the country. The SIM cards are on the water. They are coming. We have some here. Customers are testing them, or staff's testing them. So we are very close to being able to issue them. So we believe before the end of this year you'll see the thin film SIM in the market. Hopefully we can bring Kenya a Christmas present. As far as tap and go, all our cards that we are issuing are already tap and go. So all our debit cards and credit cards are tap and go. They're near field enabled. It's taking that technology onto the phone. As you've probably been following, things like Apple Pay, Apple Pay is now that technology coming to fulfillment, where the phone has near-field capabilities built into it. The majority of bottom-end phones don't have near-field capabilities built into it, but we will be issuing stickers to all our customers which will enable the near-field, the tap to go directly from a phone. Obviously, you also need, for higher value transactions, to be able to authenticate the transaction. There's a back-end process that needs to happen as far as being able to enter your PIN. So we are working on that. We have the technology in market, but as I said, near field is already up and running. How many SIM cards have we issued? We're approaching the 200,000 mark. You know, we didn't want to go aggressively. We want to make sure our systems are working and that everything is happening properly. Our customers are responding incredibly well to this. Why go and market and make a big noise when customers are already coming into the branches? So it's, the SIMs are available in all our branches. If you go into any one of our branches, you will see the kiosks that are there, so you can go and get your normal SIM. We're also selling phones in the branches, so if you go to 20 of our branches so far, you can go and buy a phone. And we're selling predominantly dual SIM phones because our strategy is a dual SIM strategy. We want people to have two SIM cards. So I think that answers the questions.
I'm sure he answered all of them, including the additions I asked for you. But John, when do we launch? The date of the launch is dependent on when we start seeing the numbers going down. At the moment, if we launched or advertised or even spoke about it, it will just increase the numbers. And issuing 10,000 SIMs in a day within the branches, because this will be the safest SIM and safest telephone line in this country, because it's all registered and connected to a bank account. Because we don't want people to have the hassles of scratching cards and all that. You just put a standing order to your account that if my airtime reaches this level, please reload. It's nothing about ever getting offline unless there's no money in the bank account. It's automatic reloading. And all our customers have been given a credit limit. So even if when you have a zero balance, you still be able to load your phone based on the credit limit that has been allocated to you. So it's purely a very convenient, it's a lifestyle phone capability. So the launch will be dependent on when do the numbers go. The delay from June to October worked very well for us because it created communication. We had budgeted we'll use 2 billion shillings to market, to educate, to launch, but our friends did that for us, and forever we'll be grateful. Thank you very much, and let's enjoy a cup of tea.